Welcome to the deep dive. Today, we're taking a really granular look, a highly focused look, at a company that's operating in one of the most technical corners of the financial world.
Specialty insurance.
Exactly. We are diving into Kinsale Capital Group, and our guide for this is their latest investor presentation from October 2025. And this thing, it paints a picture of a business model that's delivering results that, they almost seem impossible in the normally pretty state insurance sector.
It's a fascinating case study. It
Yeah.
really is. It's about operational discipline meeting this huge market opportunity.
Right.
When you talk about insurers, you rarely use words like high-octane growth or, market-crushing stock performance. But Kinsale is, well, it's the exception that proves the rule. And we're here to meticulously peel back the layers and understand the mechanics behind their profit machine.
Our mission for this deep dive is extremely targeted, very clear. We really want to understand the engine that's powering all the success. So we've got three main objectives. First, we need to establish exactly where Kinsale is right now. So that means understanding their current structure, the competitive advantages they've built, and their, frankly, eye-watering performance metrics. Second, and this is where I think the real value is, we're going to dissect how they do it.
Secret sauce.
The secret sauce, exactly.
Yeah.
Their unique underwriting philosophy, their proprietary tech platform, and, the specific strategic choices they make that just defy industry norms.
And that operational deep dive, the how, that is absolutely essential. Because you have to understand, this is not a story of some kind of financial engineering. It's a story of process, pure process optimization.
Agreed. And then finally, we'll analyze where they're going. So their explicit growth drivers, their capital strategy, and what their own management believes the future outlook is for keeping up this incredible pace.
Yeah, the ability of this company to get both high growth and superior profitability at the same time, that's what makes them such an outlier. It's something that just, it demands a really close look at their foundation.
All right, let's unpack this right now with the initial, just the stunning metric that grabs your attention right away. If you look at Kinsale between 2016 and 2024, the compounded annual gain on their stock was 49.7%.
Wow.
Let that number sink in. Nearly 50% CAGR for 8 years.
And for context, what was the S&P 500 doing?
Well, the S&P 500, which has been a great market during that time, it delivered 14.6% over that same period.
So more than 3 times the market.
Over 3 times. This insurer operating in this highly regulated, risk-averse sector outperformed the broad market index by over 3 times. We're talking about an overall gain of nearly 2,900%. How does a company whose entire business is literally pricing risk deliver those kinds of explosive high-reward returns?
That performance, that trajectory, it's not an accident. And to really understand it, we have to first place them in their exclusive operating environment. So Kinsale Capital Group, founded back in 2009, focuses exclusively on the excess and surplus lines market, or E&S as it's known.
E&S. Yeah, it sounds a bit obscure. If you're a business owner or homeowner, you're usually dealing with what's called the standard market. So can you paint a clearer picture of what this E&S niche actually is?
Certainly. Think of the insurance world as having 2 main lanes. The standard lane, that's the admitted market, and it's highly regulated by the states.
So regulators approve the rates, the policy forms, all of that.
Everything. It provides consumer protection, but it also creates really rigid constraints on pricing. The E&S lane, the surplus lines market, that's the non-admitted market, and it's basically the essential safety valve for the entire system.
The safety valve, how so?
Yes, it's designed for risks that are just too complex, too new, too high risk, or maybe too unusual for that standard regulated market to handle efficiently. So if a standard carrier rejects a risk, let's say it's a pioneering biotech firm or a massive custom construction project near the coast, something like that, that risk flows into the E&S market. And because the policies and the pricing are non-admitted, meaning they aren't pre-approved by regulators, E&S insurers like Kinsale get this crucial pricing flexibility.
So if you're purely focused on E&S, you're dealing with all the complicated stuff, but you have the freedom to price that complication appropriately.
Exactly. That regulatory freedom, you combine that with superior risk data, and that is their bread and butter. It enables their stated and very ambitious goal to provide long-term value to our stockholders by generating exceptional profit and growth.
And what's the scale we're talking about here?
Well, as of the end of Q3 2025, Kinsale has a market cap of about $9.9 billion. But they operate with this remarkable efficiency. They're supported by only 707 employees.
Wow, that's incredibly lean.
It is. It's a lean, mean underwriting machine.
Okay, let's move directly to that machine, the operational strategy that makes those metrics possible. This is where the story moves away from just general finance and gets into pure specialized competency. Their presentation is super clear on this, laying out 5 foundational pillars that structure their entire business.
Right, and these are the 5 non-negotiable strategic choices that really set them apart from the big multi-line carriers. First, they prioritize disciplined underwriting focused squarely on the small account E&S market.
Small accounts, so they're not going after the giant, risky policies.
No, they're deliberately targeting smaller premiums. That translates into a vast, diversified book of business. They're avoiding those massive headline-grabbing risks that can swing your results wildly from one quarter to the next.
Second, and we absolutely have to spend time on this, they maintain absolute, uncompromising control over underwriting and claims.
This is a huge one.
Third, they don't just, use technology. They leverage proprietary technology to get what they call a substantial cost advantage.
All right. And fourth, their approach is thoroughly modern. It's systematic. They use a quantitative approach, leveraging advanced analytics to drive every single profitability decision. It's about removing guesswork from the equation.
And the fifth pillar is the financial safety net, maintaining a strong balance sheet, robust reserving, and growing their float and investment income. Looking at these 5, what really stands out to me is this deep commitment to internal control and technological superiority. It's a high-control, low-cost model.
It is. And let's laser focus on that control element, specifically the second pillar you mentioned, that policy of no delegated underwriting authority.
Right.
This is a huge and very deliberate operational choice. In the E&S market, a lot of carriers expand their reach by delegating their underwriting authority to outside parties.
You mean like managing general agents, MGAs?
Exactly, MGAs. The MGA handles the risk assessment and writing the policy, and the carrier just assumes the risk. It's a fast way to grow, but it's inherently risky because you're giving up control over the most critical function, risk selection and pricing.
So if Kinsale refuses to do that, they're essentially saying every single one of those small, diversified E&S accounts must pass through our own internal experts. That seems like a massive operational challenge when you're trying to sustain a 25% growth rate.
That is the tension right at the heart of their model, and that is why the no delegation rule is their competitive moat. What's fascinating is that they're willing to accept slower, more controlled growth if they have to, just to ensure that underwriting quality is perfect.
They believe that loss of control leads to bad outcomes.
They believe it leads to adverse selection and ultimately higher loss ratios.
And the data really supports this commitment. I mean, their peers might have, 8% to 42% of their direct written premiums coming from surplus lines. But Kinsale is 100% pure play E&S.
100%. They are fully dedicated to this niche, and they're executing with complete control over the risks they take on.
And this commitment to individual risk assessment is what drives their underwriting quality, which I'm sure we'll see reflected in their combined ratio later on.
Dramatically so. They are essentially substituting high-tech efficiency for what is, at its core, high-touch personal expertise.
And that high-touch expertise seems deeply rooted in the management team itself. The presentation really emphasizes the sheer experience that's packed into their leadership structure. That must be essential if they're refusing to use external delegation.
It is absolutely crucial. When you have a contrarian risk appetite, which Kinsale definitely have, you need seasoned judgment to validate the quantitative models.
A human element.
Yes. The source material highlights that the founder, chairman, and CEO, Michael Kehoe, along with the president and COO, Brian Haney, they both have 30-plus years of industry experience.
Okay.
And it's the same story with the CFO, the CIO, the chief claims officer, the chief underwriting officer. They all have 20 to 30-plus years in the industry.
So this is not a team of, theoretical quants. These are people who have navigated multiple insurance cycles, hard markets, soft markets, major catastrophes, financial crises.
Exactly. Their quantitative approach is constantly being informed by this deep historical knowledge and market wisdom. They know precisely where competitors have historically stumbled, and that institutional memory informs their current risk selection.
So if the models say yes, but 30 years of experience whispers that there might be a systemic flaw, they have the wisdom and, importantly, the organizational mandate to pause.
Correct. That deep history lends credibility to their aggressive stance in the E&S space.
Okay, now let's pivot to the component that makes this whole thing work. This seemingly impossible combination of centralized control and aggressive growth, the proprietary technology platform. Kinsale views this not as some IT department expense, but as a core competency. How does this system turn technology into an 11-point cost advantage?
Well, the technology platform is the operational lever that makes the no delegation rule viable at scale. It functions as a complete digital ecosystem. And the key feature, the most important part, is that they built it from the ground up in 2009.
So that means no legacy software, no patched up 1990s systems, no messy data integration projects.
Precisely. And that freedom from legacy burdens allows them to maximize efficiency. This system is entirely integrated across underwriting, claims, accounting, finance, everything. It's designed to minimize costly manual data entry steps and all that workflow friction.
It's like the difference between a highly specialized surgeon spending all their time filling out forms versus having an efficient system that just handles the administrative load instantly.
That's a great analogy. The technology handles the high-volume, repetitive tasks, and that frees up the highly paid, highly experienced underwriter to do what only they can do: evaluate highly complex, unique risk.
And that is the core value proposition.
Yes, it creates a positive feedback loop. Efficiency leads to lower cost. Lower cost means they can profitably price risks that standard carriers, who are burdened by complex legacy systems and higher overhead, they just can't touch.
Plus, all the data they collect must feed back into the system.
Absolutely. The systematic collection of statistical data throughout this digital process feeds their central data warehouse, which in turn perpetually enhances the accuracy of their predictive models.
That sounds like a true competitive moat. It's not just a product advantage. It's an operational moat that makes it economically unfeasible for competitors to match their pricing while maintaining the same margin.
It is. And if we connect this back to that operational challenge you raised earlier, the tension between centralized control and growth, the technology is the answer. It's what allows one seasoned underwriter at Kinsale to handle a volume of specialized small accounts that might require 3 or 4 underwriters at a peer company using cumbersome, fragmented legacy systems.
So it lets them scale without suffering catastrophic talent or administrative bottlenecks.
At least not yet.
Okay, now that we understand Kinsale's internal architecture, let's zoom out to the broader market they operate in. We established that E&S is growing faster than the standard P&C market, but let's detail just how significant that structural difference really is. The long-term data shows a really persistent advantage.
Right, and this isn't just some cyclical bump, it's a structural divergence. Looking at the periods from 2011 to 2024, the broader P&C market had a steady compounded annual growth rate, a CGR, of 5.9%.
Okay, pretty solid.
Now contrast that with the surplus lines, the E&S YAGR. Over that same period, it was almost double, clocking in at 11.6%. The growth engine of the specialty market is just fundamentally stronger.
And if you push that back even further to 2001 through 2006, when the market was undergoing huge shifts, the surplus lines EJR was an astonishing 19.6% compared to just 6.5% for P&C.
The E&S market is the necessary recipient of risk that the regulated market cannot or will not accommodate.
And it's not just about growth, it's about profitability too, right?
Critically, yes. The E&S market historically demonstrates superior profitability. If we examine the net loss and loss adjustment expense ratio, that's the key metric for claims payouts, the surplus lines average loss ratio from 2001 to 2024 was 68.7%.
And for the standard market.
The standard P&C industry average was 73.6%. That sustained nearly 5-point difference in claim costs over 2 decades. It confirms the underwriting superiority of the specialty market overall.
So that means less money is flowing out the door to cover claims in the E&S sector, which is why the margins can be so attractive. Here's where it gets really interesting, though. You mentioned that Kinsale is poised to benefit from a growing and progressively dislocated E&S market. What exactly is driving this market dislocation right now? What does that look like on the ground?
Market dislocation happens when there's a mismatch between the supply of insurance capacity and the demand for coverage. And right now, there are 3 major forces driving risks out of the admitted market and straight into E&S.
Okay, what are those forces?
First, you have the increased complexity and velocity of risk. Risks are changing faster than regulators can approve new rates and forms in that admitted market. Think about cyber liability, climate change exposure, or specific professional liabilities related to AI.
Right.
Standard carriers often just don't have the regulatory agility to price these new risks, so they default to rejecting them.
So if a company is running cutting-edge AI software and needs professional liability insurance for that, it instantly becomes a bespoke E&S risk because the standard market doesn't have an approved little box for it.
Precisely. The second force is broader capacity constraints in the admitted market. So, after periods of poor results, maybe due to inflation impacting claims costs, social inflation with larger jury awards, natural catastrophes, many large standard carriers are strategically pulling back from entire lines of business.
Like property insurance in high catastrophe zones.
Exactly, or casualty lines that have seen a lot of litigation. They are shedding risk, and that capacity deficit pushes demand into the flexible E&S market.
Okay, makes sense. What's the third one?
The third factor is regulatory rigidity. Even if a standard carrier wants to charge a higher, more appropriate rate for a complex risk, they may face regulatory pushback on those rate increases. That can lead them to just non-renew or decline the policy altogether.
And the E&S market, free from that rate constraint, can just step in, charge the appropriate rate that reflects the true risk, and do it profitably.
And Kinsale is prepared, both technologically and financially, to absorb this growing volume of dislocated business.
So they're like a surgical instrument in this high-growth, high-complexity environment. But even with all their success, if we look at the market share snapshot, it reveals something really crucial about their future potential.
This is a critical piece of context. Despite their profile and success, you have to remember that Kinsale is still relatively small. As of 2024, they were ranked 14 in the E&S market. They reported about $1.87 billion in direct premiums written.
And the total E&S market size.
The total E&S market hit nearly $130 billion that year.
So Kinsale represents only a tiny fragment, 1.4% of the total E&S market. If we connect this to the bigger picture, this small share suggests a massive runway for growth.
A massive runway.
I mean, if they maintain their expense ratio advantage, even just capturing 2% or 3% of the total market over the next decade means they could multiply their current size many times over.
The runway is enormous. They're playing in a vast, expanding sandbox, and they have demonstrably superior tools to dig for profit.
And that pure play distinction seems to reinforce their commitment.
It does. I'll reiterate. Kinsale is the only publicly traded 100% pure-play E&S company. Their competitors are heavily diluted by their exposure to the standard P&C market. This singular focus on the non-admitted space minimizes the competition from those who are obligated to focus first on the admitted market, and it allows Kinsale to remain incredibly agile and contrarian.
Okay, let's transition now into how Kinsale actually executes this broad, contrarian risk appetite through its product portfolio. Their underwriting philosophy is fascinating. They're looking for attractive pricing across this wide variety of hard-to-place risks, but they're balancing that with a commitment to maintaining a diversified book of smaller accounts.
It is the ultimate expression of their no-delegation model. It's the disciplined, centralized application of expertise across dozens of niches, all while avoiding excessive concentration. And the 2024 gross written premium distribution really proves this diversification.
Okay, so out of their $1.9 billion in GWP, the book is highly spread out. The largest segment is commercial property at 24.4%, followed by excess casualty at 13.1%. Then we see small business casualty at 10.5%, general casualty at 9.0%, and construction at 7.9%. No single line holds the company captive to some catastrophic event.
That diversification is crucial for managing volatility. They are essentially taking a large volume of small, uncorrelated bets. So that means if one niche experiences some adverse development, say a surge in construction litigation in one state, the impact is buffered by strong results in, say, ocean marine or high-value homeowners.
But let's dig into the difference between some of these segments. For a listener, what differentiates something like small business casualty from general casualty, and why is that distinction important for Kinsale's strategy?
That's a great question, and it speaks directly to their focus on the small account. Small business casualty typically focuses on highly defined, low-limit liability policies for smaller firms. Think a local cleaning service or a small contractor. These are high-volume, quick-turn policies where their technology platform's efficiency is absolutely paramount.
Okay.
General casualty, on the other hand, might cover slightly larger, more complex operational risks. Maybe liability for distributors or manufacturers, where the risk assessment is inherently more complicated and requires more of that senior underwriter's time.
So small business casualty optimizes the low-cost volume, while general casualty optimizes the higher complexity of the mid-market. It's like a dual-pronged approach to efficiency and expertise.
Exactly. And this highly dynamic selection process is best revealed when we look at the compound annual growth rates, the CAGR, between 2022 and 2024. While their total commercial GWP CAGR was strong at 30.6%, they are clearly finding phenomenal pricing opportunities in specific high-velocity areas. This shows them pivoting aggressively where the market dislocation is highest.
Let's detail those massive growth segments because these numbers are just phenomenal and they tell us exactly where the market is dislocating the fastest. The top growth driver in the commercial space was commercial auto. It grew at a staggering 142.7% TGR.
Just incredible.
It expanded from roughly $6 million to $35 million in just 2 years.
That is explosive growth,
Wow.
and it's deeply revealing. Commercial auto is a line that has experienced massive losses for many admitted carriers recently. You have inflation in parts and labor, you have social inflation leading to these huge jury awards.
So the standard carriers are running for the exits.
They panic, they pull back capacity, and the market instantly dislocates. And Kinsale, with its superior data and controlled pricing, just steps in to capture the appropriately priced risk.
Okay, second, we see Ocean Marine with an 118.6% AGR, showing a similar opportunity in niche transportation risk. And the third major commercial driver was small business property, growing at a 91.2% CAGR.
Yeah, the property segment growth, especially for small businesses, suggests that standard carriers are tightening their belts even on smaller diversified property risks, likely because of aggregated catastrophe exposure concerns.
And this feeds directly into Kinsale's sweet spot again. Small accounts, hard to place, requiring tailored E&S solutions.
We also see powerful growth in entertainment, which was up 62.1%, and the larger commercial property book up 58.5%.
And what about the personal segment? We saw massive growth in one very specific area, high-value homeowners, which had a mind-blowing 186.9% CAGR. It grew from about 3.3 million to nearly 27 million in just 2 years.
This is a perfect illustration of the structural problem created by climate risk. If you want a high-value home in a coastal area or a wildfire zone or tornado alley, standard carriers are increasingly unwilling to take that single, large risk exposure.
Or they're forced to charge rates that regulators won't approve.
Exactly. That complexity and exposure instantly pushes the risk into the E&S market. And Kinsale, using its specialized underwriting, is seizing that highly profitable, high-value, dislocated personal risk.
But this isn't just a story about growth. This dynamic portfolio management, it includes active subtraction, which I think confirms their discipline. Which segments did they choose to shrink during this period?
They show a clear willingness to exit lines, where pricing has compressed or risk profiles have worsened. For example, between 2022 and 2024, life sciences contracted by 6.4%. Management liability shrank by 13.3%, and the standard personal insurance segment, so excluding that high-value homeowners focus, that decreased by 16.0%.
That demonstrates the contrarian risk appetite in action. It's not about being contrarian just for the sake of it, but being contrarian based on data. They exit where others are aggressive, and they become aggressive where others retreat.
That's it exactly. They are constantly adjusting their capital deployment based on a quantitative analysis of risk-adjusted returns. If a competitor floods the management liability market, causing prices to fall below Kinsale's internal threshold, they just pull back capacity from that segment and redeploy it into commercial auto or small business property, where the dislocation offers superior margins. This dynamic optimization is key to maintaining their exceptional combined ratio.
Let's move to the ultimate scorecard for any insurer, the combined ratio. This is the single most important metric for underwriting profitability. A combined ratio below 100% means the company is making money purely from underwriting policies before they collect a single penny of investment income. And Kinsale's combined ratio story is, frankly, peerless.
This is where we see the payoff of everything we've talked about. The no delegation policy, the experience of the management team, the efficiency of the tech, it all coalesces into these hard numbers. And we have to use the peer comparison data, the 2022-2024 averages, to really grasp the magnitude of their advantage.
Okay, so when you look at their specialty insurer peers, the average combined ratio was 91.7%, meaning peers made a healthy but not exceptional underwriting profit.
Right.
Kinsale's average combined ratio during that same period was a breathtakingly low 76.8%.
That 15-point difference is not just large, it is transformative. It fundamentally redefines the margin potential of every single dollar of premium Kinsale collects compared to its competitors.
So in simple terms, Kinsale is retaining 23.2 cents of underwriting profit on the dollar, while the peer average is retaining just 8.3 cents.
It's a whole different business model at that point.
Let's break down where that 15-point advantage comes from, starting with the loss ratio, which reflects claims payouts. Kinsale's average loss ratio was 55.6%, which is better than the peer average of 59.3%.
And that 3.7-point difference is the proof that their disciplined, centralized underwriting, that no delegation policy, it works. They are simply better at selecting and pricing profitable risks, which leads to lower claims costs compared to the industry norm.
But the truly decisive advantage, the technological moat, is in the expense ratio. This is the operational cost of just running the business. Kinsale's average expense ratio was a lean 21.2%. The peer average was 32.4%.
That 11.2-point gap, that is the core competitive advantage provided by their proprietary integrated digital platform. It means their cost structure is just drastically lower.
That's a huge hurdle for competitors.
It's an almost impossible hurdle to overcome. Think about it. If you are a competitor averaging 91.7%, you could theoretically match Kinsale's loss ratio, but you would still need to generate 11.2 points more investment income or find 11.2 points more in pricing power just to catch up to Kinsale's underwriting profit.
It's a phenomenal structural advantage. They are not only better at picking profitable risks, but they are dramatically cheaper to run than every single major peer. And the synthesis of this performance is clear. Kinsale achieves the lowest combined ratio, 76.8%, while also maintaining the highest 2022-2024 net premiums written CAGR at 25.6%.
They are executing the high-growth, high-profit strategy simultaneously, which is the definition of value creation. They're outpacing the peer average in both metrics, profitability, and growth. They are gaining market share from competitors who are less efficient and less profitable.
And zooming in on the most recent data, the snapshot from Q3 2025, we see this momentum is continuing to accelerate. Gross written premiums were up 8.4% to $486.3 million, but the combined ratio actually improved further. It dropped to an even more stunning 74.9% in Q3 2025.
This indicates the efficiency gains are continuing. That led to quarterly underwriting income of $105.7 million. And this efficiency, it translates directly into investor returns, specifically the operating return on equity, or ROE.
Their operating ROE trend has been on a rocket ship. It's climbed from 14.7% in 2020 all the way to 29.2% in 2024. And as of Q3 2025, the annualized operating ROE was 25.4% or 28.2% for the 9 months. This raises an important question. We know what ROE is, but how does maintaining such a high ROE practically sustain future growth in an insurance context?
Well, if we connect this to the bigger picture, you should think of ROE as the efficiency of their capital engine. The higher the ROE, the more profit the company generates from its existing shareholders' capital.
Right.
So when a company earns 25% or more on its equity, it means that profit can be retained and then reinvested. That retained profit instantly expands the company's capital base, which is the regulatory foundation you need to underwrite more risk.
So Kinsale is generating massive amounts of internal capital. This means they don't have to constantly go to the market for new funding to fuel that 25% growth. They're self-funding their aggressive expansion.
Precisely. They are compounding capital at a highly accelerated rate. And this efficiency means their book value per share grows consistently and rapidly, reaching over $80 as of Q3 2025. That growth is the tangible result of decades of operational discipline and technological investment.
So we've established Kinsale as an exceptional underwriter. Now we need to look at the other side of the insurance business, investment management. In specialty insurance, the money you hold to pay future claims, what we call the float, is arguably just as important as the underwriting profit. This float is the pool of funds that generates investment income.
And let's be really clear on what float is. It's the sum of reserves for unpaid losses and unearned premiums, minus receivables and acquisition costs. And since Kinsale underwrites profitably, their combined ratio is below 100%, this means they are effectively generating their float at a negative cost.
Which is the dream scenario for an insurer.
It's the dream. They're being paid to hold and invest other people's money.
And that float is expanding dramatically, just mirroring their premium growth. It has more than doubled in 4 years, surging from about $1.35 billion in 2020 to over $3 billion by Q3 2025.
That growth rate is staggering. It's a direct result of two things: the rapid expansion in gross written premiums, and critically, the management's confidence in their own reserves, which is driven by their superior claims and underwriting data. This burgeoning pool of funds constitutes the primary capital for their investment portfolio.
And we can see the immediate impact in their net investment income trajectory. Net investment income grew from $26 million in 2020 to $150 million in 2024. And for the first 9 months of 2025, they were already at almost $140 million. So the investment engine is generating significant ancillary income that supplements their superior underwriting profit.
So now we analyze how they manage this capital pool. As of Q3 2025, Kinsale managed a $4.8 billion investment portfolio, And given their primary duty is to ensure they can pay out claims when they fall due, their focus is conservative. It's aimed at quality and liquidity.
And the average credit quality reflects that.
Yes, the average credit quality of their fixed maturity portfolio is strong.
No. An AA rating confirms a commitment to high-quality investment-grade securities. That's pretty standard for an insurer, but let's detail the allocation strategy. We see 88% of the portfolio in fixed maturity securities, with equities making up the other 12%.
This allocation strategy reflects the stability required to back up their policy liabilities. And within that fixed maturity portfolio, the allocations are highly specific. The heaviest chunk, about 21%, is in corporates. This is followed by residential mortgage-backed securities, or RMBS, at 21%, and asset-backed securities, ABS, at about 15%.
So these are generally liquid, high-quality, diversified debt instruments.
Correct. And the quality control within that fixed maturity segment is evident. Over 30% of the portfolio is AAA rated, another 25.6% is ABA, and 24.6% is A rated. This is not a firm that's chasing speculative returns. They are maximizing income while rigorously safeguarding the capital base.
So their main profit generator is still the underwriting engine.
Precisely. They recognize that their primary profit generator is the underwriting engine, that 76.8% combined ratio, not making aggressive bets in the investment markets. The investment strategy is designed to support the operational strategy, not replace it.
We've thoroughly analyzed Kinsale's structure, their operational genius, and their financial results. Now let's synthesize their forward-looking strategy. The presentation outlines 6 key drivers they intend to lean on to maintain this highly profitable growth trajectory.
Right, and these drivers are essentially a formal declaration that they're going to continue to execute their existing playbook with unrelenting discipline, all while capitalizing on external market trends.
Okay, so first, they plan to expand their presence in the E&S market. That means continuing to leverage the ongoing market dislocation we detailed, the flight of complex risk from the admitted market.
Second, the core of their operational advantage. They will emphatically focus on smaller accounts. This is where the competition is lowest, and where their high-efficiency tech platform gives them the greatest pricing edge. They can make money on risks that their larger, slower competitors couldn't touch without losing money due to high overhead.
Third, and this is fascinating, they intend to maintain a contrarian risk appetite. We discussed that they are willing to underwrite risks others are fleeing, provided their data validates the profitability. What might that look like in the next 5 years?
Well, it means that if, for example, a wave of legislative changes causes standard carriers to flee a specific area of professional liability, say architects and engineers working on certain infrastructure projects, Kinsale is prepared to step right into that capacity vacuum.
So their contrarianism isn't just a gut feeling.
No, it's a quantitative assessment. It says, if the current market is overpriced, we will exit. If the current market is irrational and underpricing a risk due to panic, we will step in and price it correctly. They have the confidence and the capital to take the other side of the trade when the market panics.
Fourth, they will develop new product offerings in areas where their expertise exists. We saw this with the explosive growth in commercial auto and high-value homeowners. They identify a need created by dislocation, and they rapidly build the underwriting capability to serve it.
Fifth, they commit to continuous technological improvement. They will constantly leverage technology for ongoing efficiency enhancements. The 21.2% expense ratio is already outstanding, but they recognize they have to keep innovating to maintain that advantage.
And finally, they will maintain a strong balance sheet to ensure they have the financial platform necessary to absorb growth, volatility, and future opportunities without having to slow down due to capital constraints.
So what does this all mean when we put the pieces together? Kinsale strategy isn't just a collection of disparate tactics. It is a meticulously engineered, closed-loop, self-reinforcing virtuous cycle.
Walk us through that cycle one last time, because this really is the core takeaway for the listener.
Okay, you start with the foundation. The low-cost, proprietary technology, and the expert, centralized management. This enables an industry-leading, superior expense ratio, that 21.2%.
Right.
This efficiency, coupled with disciplined risk selection, no delegation, drives a sector-leading, ultra-low combined ratio of 76.8%. High underwriting profits, combined with rapid premium growth, generate massive and high-quality float. That float powers a conservative but highly effective investment income engine. All of this combined leads to rapid capital formation, which results in that superior operating ROE.
And that strong capital base is what finally funds their aggressive yet disciplined market expansion and new product development, that 25.6% growth.
Exactly. The stronger they get, the faster they can grow, and the lower they can price risks profitably.
It's a machine designed to compound capital and outcompete any firm that's burdened by legacy systems. The key takeaway numbers that define this machine are that exceptional net premiums written CAGR of 25.6% achieved simultaneously with the industry-leading low combined ratio average of 76.8%.
That combination is their value proposition, their competitive moat, and the source of their superior shareholder returns.
They've identified the most profitable niche in insurance, they've built an operational model that maximizes efficiency within that niche, and they are executing with extreme discipline.
Leading to returns that rival technology companies, not typically specialty insurers.
We have completed our deep dive into Kinsale Capital Group, guided by their October 2025 presentation. They stand as a powerful example of how extreme operational discipline, backed by proprietary technology and expert management, can translate complex, high-risk insurance into exceptional and repeatable financial outcomes.
Their foundation rests on absolute, non-negotiable control over underwriting and claims, powered by an integrated technological infrastructure that yields a dramatic expense advantage. This pairing of structural efficiency and superior risk selection has allowed them to consistently outperform peers across every critical financial metric, from combined ratio to ROE.
This has been a truly comprehensive look into how a focused, pure-play strategy in the high-growth E&S sector can be executed for phenomenal results.
And here is a final provocative thought for you to explore as you consider Kinsale's future trajectory. The source material clearly showcases their ability to grow high-velocity segments exponentially, such as commercial auto at a 142.7% CAGR and high-value homeowners at 186.9% CAGR. Their entire industry-leading low combined ratio rests upon the commitment to highly individualized, non-delegated underwriting, which is an inherently high-touch, talent-dependent process.
The ultimate operational tension lies right there. How long can Kinsale maintain that strict internal underwriting control and quality, the hallmark of their model, as those high-growth product lines scale so rapidly? Is the proprietary technology truly robust enough to prevent operational bottlenecks and maintain the current critical 11-point expense ratio advantage if they must hire and train dozens or even hundreds of new expert underwriters just to keep pace with a sustained 25% annual premium climb?
That scalability challenge, rather than market capacity, may be the central tension determining the long-term sustainability of their exceptional profitability.
Something critical to ponder as you look at the future of specialty insurance and the limits of the non-delegated model. Thank you for joining us on the Deep Dive.